Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
All right. Happy Monday.
Yes, sir. It is a happy Monday.
August the 25th already.
Yep. We're moving right along.
So listen, I wanted to talk to you about interest rates, because everybody's kind of sitting still waiting for the Fed to do a Fed drop. We're pretty sure we're going to have a Fed drop. It's like an 89% of a half a point. So, I'm pretty sure that's going to happen. So
isn't it 100% of a drop period? Like that's the prediction. It's just a matter of whether it's a quarter or a half, right?
Yeah, there's going to be, but there's an 89.9% chance that it's going to be a half a point.
That's a significant drop.
It is. So I'm predicting that we're going to have 3 drops. Okay. All the economic indicators say we're going to have 3 drops, and they say we're going to have them by the end of the year. I don't think we're going to start seeing a great deal of improvement till probably around March. Okay. That's the Blona Rangers prediction.
All right.
For all that's worth. I just think it's going to take time for these things to settle in, because we've talked about what happens when the Fed does a Fed cut.
Correct.
And why have we seen situations on multiple occasions where rates went up instead of down, even though the Fed dropped the Fed rate?
Yep.
So why do you think that happens? What do you think the reason is for that?
I think one of the things is that as soon as people start talking about it, like now, I think I've been hearing it for about a week, the market starts baking in that assumption, right? And the other thing is that the Fed rate itself doesn't directly impact mortgage rates. It indirectly impacts them over a longer period of time, right? So as money shifts around, it's going to get actually pulled out of the bond market into the stock market, right? Initially. And then
that's exactly what happens. Is you have to understand, first of all, mortgages are not tied to the Fed rate. They're tied to the bond market.
Mm-hmm.
Okay. And when the bond market's doing well, then interest rates improve. Well, bonds are a safe haven for institutional money. So they park money in bonds when they're uncertain of what's going to happen to the economy. So they're like, yeah, things are looking a little crazy. Let's just park it over here. We'll make 4.25% or 3% or 1%, but we won't lose any money in the market.
Right.
So when the Fed drops the Fed rate, money then flows into the stock market. You're going to see the stock market rally, and it could pull energy and money out of the bond market, and then that negatively affects interest rates. But you made a very important point. And that is that you've already seen the drop. The drop's already there.
Correct.
If I put on, and tell me if you can see this, if I put on today's market and we truly look at what exactly is going on.
Let's get ready for Monday Mortgage.
Stop doing that.
That'll get some views right there.
There you go.
So we see that the market is down right now. Okay. Can you see that bond market? Okay.
Yeah.
All right. So are you seeing it when I scroll through here at all?
Yeah. Mm-hmm.
Okay. So I want you to see a chart. So these are all the economic news that are coming out. And then here's the bond chart. Now, if we look, this is today. Okay. Whoa. This is today.
Good. Yep.
All right. And you can see we're down for the day, but we're up from Friday. That was Friday.
All right. That green is Friday. Right. Okay.
That's right. So it's been pretty flat for the last 2 weeks. You see that? I mean, that's not a lot of movement. This was our day. This was a Friday, August 1st. That was a really incredible day. That is really when everything started. The market was pretty sure we were going to get a Fed cut, and that's when we saw that improvement. Now, leading up to that Fed meeting, it's all over the board. So we don't know what's going to happen. If we expand this even further and we go back into time, you're going to see these resistances. These are called ceilings of resistance. And we're having trouble piercing these. We had trouble piercing this one. We're still at it. You see how it's tough to get above it? If we can just rise above this, this will become our next ceiling of resistance. And that would be a good place to be. That was back from April 7th of 2025. Now, you can see we have a long way to go to get to even where we were back in September of 2024. But that would give us rates
which wasn't
in the
even
low
really the best. Right. I was going to say that wasn't even really the best time ever, right? That's just more normal.
It wasn't. It absolutely wasn't. I mean, you want to go back. These were COVID days, you can see, and that's when rates were at 3%. But
right. Those
were
were
at
free.
The bond market was at 112. We're at 100. So that's 12 points off to get that rate. That's where you'd be. So should we lock or should we?
So let's talk about, that's some deep stuff, right? And that's some stuff that, I think a lot of times people hear that and they get glossed over and like, just tell me what to do, right? So I get that because I don't want to understand the bond market like in depth. I'm good with how smart I am. So what should I do if I'm
You're good with having me as a friend. That's what it is. And I know.
That's right. That's how smart I am. I have you as a friend. So what do I do if I'm a homeowner or a wannabe homeowner and I'm just about ready to pull the trigger? I've got my down payment. I cleaned up my credit score. I'm finding houses. And then somebody says, don't buy now. The market's going to, what do I do?
Well, I'll tell you what you do. You do not listen to your friend because your friend doesn't know what they're talking about. Your friend is of the thought that the general population that is ill-informed is up. And it's not the way to go. You cannot time the market. I can't time the market. You can't time the market. Wall Street isn't even timing the market. But there are indicators. So are we expecting to see a rate drop anytime soon where rates are going to go from the mid sixes, say, to the high fives? No, I don't see that happening. I think it's going to take 3 rate cuts, and that is going to take rates to come down and inflation to stay down at the same time, because inflation is the arch enemy of the bond market. Right. So if inflation starts to go up, and you have to remember, when you cut rates, what do people do? Start spending more money. So if they spend more money, then prices can go up, and then we can have inflation. So it can be a double-edged sword.
Yes, for sure.
You cannot predict the market. What I would suggest you do is there's no such thing as a rich renter. And if you are looking to purchase a home right now, then I would highly suggest that you get into the home. If rates drop in the next 6 months, then refinance it. That's all you have to do. But you can't refinance the price of the house. You can only refinance the interest rate. Now, if interest rates drop, more people are going to flood the market because let's just face it. Probably 7 out of 10 people that would like to buy are of the thought that rates are going to drop or the market's going to crash. Neither one of them are going to be significant. The market's not going to crash and interest rates may drop, but they're not going to drop significantly. They're going to drop a little bit. You can take advantage of that later. But if you wait for that now, all those people that are waiting to get into the market will flood the market and sellers will have no reason to cut a deal.
Correct. I agree. So if I'm about to, one of the things that I always lean on you for is, when my buyers are in a contract to buy a house and we're in that 3 to 4 week window between contract acceptance and closing, right? When do they lock? Like what's the right strategy in an environment when rates are predicted to come down, but are not guaranteed to come down? What do we do?
So the right thing to do is really difficult. The right thing to do is to have a mortgage lender that you can trust. But the mortgage lender that you can trust still, they don't have a crystal ball any more than anybody else does.
Understood.
So when you're buying a home and you're under contract, the day that you're under contract, you are eligible to lock your rate in. Now, you have to remember that interest rates that lenders lock are typically priced on a 30-day lock. So when you call me up and go, what's today's rate? It's 6 3/4 and 1 point. Okay, that's a 30-day lock. That's not a 200-day lock. You're not getting that guaranteed and closing in 200 days.
Right.
So 15 days is your cheapest, then 30, then 45, then 60. Then it's extended rate lock.
So generally speaking, I would want to wait until 15 days before closing.
I don't really think that there's that much of a benefit. To be honest with you, if we looked up rates right now, you would find such a small difference between the 15 and the 45. Even the 60 sometimes is not that far off from the 30. So if you are a nervous buyer, and you're like, I just don't like it. It freaks me out. I don't want to watch the market every day. I don't want to call Bruce every day to see if I should lock. Then lock on a 60-day lock.
Okay.
It's easy. If you are of the thought that, I'm going to play this out. I'm going to roll the dice. I'm going to see what happens after the Fed cut. Well, then that's fine. Do that. You may benefit from that. You may not.
Now, what about, I've heard about locking to float or float lock or something like that. What's floating lock?
So we give what's called a float down option. So in other words, let's say that you locked today for a 45-day lock at 6 3/4% and you paid 1 point.
Okay.
Well, we're 15 days from closing and rates drop to 5 3/4.
That's a big drop.
It's not going to happen. But let's just say they drop to 6%.
Okay.
Typically, what the lender will do is they will honor a one-time float down. You get it one time. You can't keep doing it.
Okay.
And it's got to be at least 1/4 point in interest rate reduction. That's a significant drop. And what the lender does then is split the difference. So if it's 1/4 point better, I'll give you 1/8 point better on your rate. That's typically how they do it. Now, listen, it's actually, people say, that doesn't seem fair. Why don't you just give me the current rate? You have to remember that when a lender locks that money in, they're securitizing that in the market. It's just like you bought a stock. You can't buy Google stock for $2,000 a share and then on Thursday it drops to $1,500 and call them and say, hey, I want $500 a share back on this in my pocket. And they're not going to go, we won't give you 500, but we'll give you $250 a share. They won't give you anything per share. You're not getting anything. But on a mortgage, typically your bigger lenders are going to honor a float down option. Are they exercised very often? I don't find them to be exercised very often because we don't generally see massive swings in the market in a 45-day period of time. It just doesn't generally happen. But it does happen from time to time, and you need to consult with your lender to discuss their float down option policy.
Great. Well, that's good to know. So bottom line, we've got a market that is getting ready to be a little bit better potentially over the next 6 to 9 months for buyers, but it's also going to get better for sellers because there's going to be more buyers in the market. And the advice I think we always give stands, right? If you're ready to buy. If you're not ready to buy, get ready to buy.
Look at marry the house, date the rate. We can always change the rate. Anytime, anybody that has a mortgage with me, they don't pay any lender fees when they refinance. We absorb the appraisal cost. There's all kinds of things we do to help that client so we don't lose the client. We don't want to lose. I don't want to do a loan today for you at 6 3/4 and 6 months later it drops to 5 3/4 and you leave me. I don't want that. So I'm going to do what I can to service that transaction. Now, the benefit for my company is we service over 90% of the mortgages that we close. Right. Most lenders are going to sell that mortgage and you're at the mercy of whoever owns it at that particular time.
Yep.
Okay.
Awesome.
So buy now, refinance later if it drops. And if you want to discuss a float down option, that's an option. But buy now, houses aren't getting cheaper. You've got a real good market. Sellers are working deals. Sellers are paying closing costs. Sellers are doing rate buy downs. Sellers are fixing roofs. Sellers are fixing plumbing. It's just insane. The sellers are doing so much for buyers. But 7 out of 10 buyers, they don't see it. They don't see it, Tom. They're blind to what's going on. And I really hope that they watch this and they realize that now is truly the time. It really is. It's a great market to buy.
Bruce, we ran a few minutes over. You have a
Peace
beautiful
out.
week. Talk to you later.